Shawn's going to talk about the exciting new Trump accounts, something very new and novel in the tax code with a lot of issues. Thanks, Shawn.
Thanks, Steve. Thank you also, Marty. Good morning, everybody. So, as some of you may or may not know, I kind of chose this topic because nobody really knew how this was going to work and what was going to happen. And then I got up yesterday morning to an article in USA Today, no commentary on where I got that article from, that Michael Dell was going to contribute $6 billion with a B, all right, to these Trump accounts that nobody knew how they worked. All right. So, but in that article, there was also a comment that said, expect some IRS commentary by the end of the day. This was yesterday. All right. So prior to that, I had an outline, I think it's up there, okay, that I was trying to look for a novel way to discuss the topic and say, hey, let's compare these potential accounts to things we already know, 529 accounts or UTMA accounts, all right? I will no longer be doing that, right? So, because last night about 6 o'clock, the IRS issued said notice. It's 2025-68 for anybody who wants to look this up later, though I imagine everybody else has already read it, besides me. And so that kind of put a little monkey wrench in my presentation today. So the first question that's up there, okay, and this is also not a political commentary, do we really have to call them Trump accounts, okay? And so previously I was going to say no, probably not. But there are a lot of other accounts or other things that the feds have come up with that have their own names. For example, Pell Grants. I don't know if people remember Pell Grants. You also have Keogh plans, as my partner Marty pointed out to me the other day. You also have what's known as Obamacare, but that's not really its real name. Okay. But I'm pretty sure at this point, these things are going to be known as Trump accounts for as long as they exist. Right? And here's why. One, you're going to keep calling that forever, okay? You're going to make an election at some point, all right, in one of two fashions, and these elections I'll get into a little bit, that on what's called now Form 4547. Don't bother looking for it, it's not available. But I can almost guarantee at the top of that, it will say Trump account election form, all right? And once it's on there and the IRS has it, we're toast. Now, the other part of that is there's a potential to do this electronically or some online tool. And that can be found at, you guessed it, trumpaccounts.gov. Okay? So I think the name is here to stay. Originally, when these were first thought about, it was a couple of billionaires sitting around talking to their family. It was called Invest America. And the concept was, hey, let's take money and fund savings accounts for kids. Allow them to grow, and then turn into something over time, right? That became the concept of how do you fund them, what's the access, what's the taxation, what are the contributions, all those kinds of things that nobody really knew an answer to, okay? And it's not perfectly clear, but we got a little better idea from the notice that came out last night. So, I'm going to talk about the Michael Dell aspect of this in the context of how these things get set up. So we already talked about how the election is made, right? There will be a Form 4547, right? You can do it online at trumpaccounts.gov, okay? However, they talk about this being potentially available for the election to be made around tax filing time for 2025, which would be April. But you can't fund any of them, all right, until after July 4th of 2026, okay? And people will remember that date as a date in which the original One Big Beautiful Bill was passed. So one thing I would, and I do want to keep that's in my outline, I think it's up there, is the $1,000 the government's going to put in the account free, okay? Yes, kind of. And the reason why I say that is what we all supposed was going to happen was that the federal government was going to set up these accounts, all right, for anybody born within a certain time frame. That was December 31st, 2004. So anybody born in 2025, up through January 1st, 2029. So anybody then born in 2028. Okay, the accounts would be set up, and the feds would put $1,000 in that account. All right. So what that is now called under the notice, okay, is the pilot program. Okay, so those eligible beneficiaries is what they're called. They have to be born within that time frame and have a social security number and go through the process of electing to have the account set up for them and funded then by the Treasury. Okay. What wasn't known then and is known now, that it's not exclusively for beneficiaries born in that time frame. Okay. The pilot program, meaning the $1,000 that the feds would put in that account, only applies to the people whom I mentioned. But these accounts can be set up for anybody under the age of 18 so long as their birth date does not take place in the year in which the election is made. They just don't get the $1,000. Okay? But they can have the same type of accounts to be funded by whomever you want to fund them or whoever is going to fund them. The other thing that is about some of these accounts, okay, is that their taxation when the funds come back out. And there's mention in the notice for those of you who read it about whether or not basis would attach to any of the contributions. Okay? So let's talk about who can make contributions. Okay? So the period between the time the account is established and when that, in the year in which that beneficiary turns 18 is called the growth period. Okay? Limited access, limited rights to contribute, caps on the contributions. Okay. So the first, those can be funded in 5 ways. And I apologize, I normally would not have to read my notes this much, but since I was working on this last night, I'm reading my notes more than I planned. My apologies. Clearly, as they fund them during this growth period, the pilot program contribution is permissible. Okay, it'll be $1,000. You can also then have qualified. You love that term, qualified. Yeah, everything with the IRS is qualified. So qualified general contribution to a qualified class of account beneficiaries. Okay? So those contributions can come from states or political subdivisions, the United States itself, the District of Columbia, because it's not a state, Indian tribal governments, and here's an important one, I think, 501c3 charitable organizations. Employer contributions, okay. Qualified rollovers, meaning from one Trump account to another Trump account. And then other sources like the beneficiary themselves, parents, or any other person, okay. Now, I mentioned basis. Some of those come with basis, some do not. And those who are tax practitioners can probably guess which ones do and which ones don't. So if the account was funded with post-tax money, you get basis. Right. So if the account is set up for an eligible beneficiary and it's funded by their parent or their grandparent or somebody else, that's after-tax money, right? You get basis, right? Which becomes important when you take withdrawals later, if you haven't already figured that part out. Some of which do not come with basis. States, political subdivisions, the United States, the District of Columbia, Indian tribal governments, and charitable contributions, or things that come from 501c3s. No basis, right? No basis in the employer contributions, which are capped at $2,500. So you can put in $5,000 a year, okay, into these from whatever source, but no more than that, okay? And that's from all sources, okay? So it's not $5,000 per source, right? It's all sources, right? The $1,000 doesn't count, okay, towards that, so you can still get $5,000 when you put in that account. So that $2,500 coming from the employers, no basis because nobody paid tax on it, okay? So the contribution is coming from an employer to the beneficiary who would be, you know, an eligible beneficiary as being the son or daughter or whomever of the employee, okay? But no basis because the employee is not paying tax on that, okay? Which makes you wonder, is it a deduction from the employer's perspective? My guess would be no, okay? But we don't know for certain. And then clearly any qualified rollover, meaning from one Trump account to another Trump account, would have transfer basis, because, let's make it as complicated as possible. So, as I mentioned, all the contributions are not tax deductible during the growth period, okay? Once the growth period ends, whole different new set of rules. They're treated more like IRAs at that point, right? Which makes you think, well, maybe we wouldn't do Roth conversions, or now you can make additional contributions. You can take funds out after the growth period on a limited basis until you reach 59 and a half, and then there's no penalty. Same kind of stuff with the IRA as we have it right now. Okay. But what about distributions before they turn 18? Right. Clearly, we talked about the rollover aspect of it. Okay. So that is not a distribution. You can, prior to them turning 18, take the account and roll it into what's called an ABLE account. If you're familiar with what an ABLE account is, it's set up for a special needs portion of it so that it can be set aside and not count against as an accessible resource for people who are looking to qualify for Medicaid. You can take out whatever went in above the $5,000 number. And so if somebody put too much in, you have to take that back out. And if the beneficiary unfortunately passes away prior to turning 18, the account terminates and it comes back. There are different rules for that, but we don't really have enough time to cover everything. Okay. So then, as I already talked about, we've got, when they hit the age of 18, the beneficiary, they can then, treat it as if it was an IRA. The election itself is made by an individual, and there's a priority of the individuals to make the election: legal guardian, parents, adult sibling, grandparents, and then the beneficiary actually themselves, in that order. So only one person can make the election because you can only have one account, okay? So when the elections are all processed and in, again, it says the secretary will make determination of who set up the account. They're the responsible party. Okay, kind of like the custodian of a UTPA account or a 529. Right. So let's talk about what Michael Dell did. I just want to make sure we get enough time because this was going to get longer than I anticipated. So he committed to contribute, okay, actually about $6.25 billion to this program. And the way it's described, okay, both in the New York Times and on the White House's website, is that this will allow contribution of an additional $250 to accounts that are getting $1,000. Well, I'm not too sure that's going to work because of a little bit more of this. His contribution is restricted. Right? So remember I talked about qualified contributions to a qualified class of account. That's what Michael Dell did, or is planning to do. He hasn't done it yet. You can't fund these things. And so his contribution, okay, and where it goes from there, is limited to zip code areas in which the median income is $150,000 or less. Okay. And only applies to children up to the age of 10. So if you don't fit those criteria, you won't get Michael Dell money. Okay. He, Michael, Mr. Dell, called this philanthropy. Okay. But as you recall, I said contributions are not tax deductible. Okay. Unless, okay, and this is just a theory on my own part. If he makes the contribution to his friend, there's a foundation out there called Invest America. Okay. Can't remember the guy's name off the top of my head, somebody might know. He's a hedge fund billionaire. And he came up with this concept to begin with. But let's say he makes the contribution, or somebody else, a client or somebody else, makes the contribution to a qualified charity. Get the tax deduction for that. Okay. Now the charity, because anybody can fund these accounts, can then fund those accounts. Okay. Charity doesn't care if it's tax deductible. It just has to qualify as a permitted contribution under the rules. So that's what I think will end up kind of happening with these things, because you call it philanthropy, you call it whatever you want. They're trying to pay it forward, but I'm not trying to poo-poo the idea. I'm just saying it's going to be a little complicated. So here's a quote, all right, and this quote came from not USA Today, this actually came from the New York Times. So according to Mr. Dell, they are still working through the details. No kidding. It just came out last night. So, and how these funds would get to the individual children. The Treasury Department is going to be highly relied upon to set the accounts up, to fund the accounts, to process the paperwork. I don't know if anybody's called the IRS anytime recently. And then meet the criteria that he has set forth on the funds provided. Okay, and here's the direct quote. And then we will transfer the funds. Okay, and the Treasury Department will immediately transfer those funds into the accounts of those children. Okay. So again, I kind of gave you what my theory is on how these might work going forward, but now that we've got a little more guidelines, I'm happy to talk to anybody afterwards who else has already read this and kind of go through it. There are all kinds of requirements, just like IRS. There's going to have to be a trustee. Somebody's got to have to do reporting. And I think we're going to take Q&A at the end, but okay. You can ask your questions at that point. So again, thanks everybody for attending. I apologize for the little haphazard change of program on that item. Thank you.
The charity that would be sponsoring this would have to obviously be entitled to make those distributions to accounts. So
yeah, there seems to be.
There's a lot of infrastructure.
Yeah, I think clearly. I think there's going to be some kind of qualification out there that the charity will have to meet in order to then pass these funds to these things. But I think a big part of that is they're not just generally available. They can actually set the criteria, much like Michael Dell did, say, hey, I'm going to fund these, but only for these people. And so a state could fund them specifically for kids in their state. Okay? Or Michael Dell's initial thought was he was only going to do this in Texas. Okay? Now he's going nationwide. So.
Thank you, Shawn. Our next quick topic is on items that will affect all of you, how you report on your 1040s this year. There's been a lot of changes, mostly favorable. Jason, is that yours?
That's me.
Thank you.
Can everybody hear me?
Yeah.
Okay, good. So thank you everyone for being here. The One Big Beautiful Bill Act of 2025, which I think going forward I'll just refer to as OBA. We do have some significant changes in terms of federal income tax rules, particularly in the area of itemized deductions, senior discounts, Social Security, and PEAS limitations, since there are limitations on itemized deductions. So I just want to give a summary of what's going on in that area. The first one, the one that a lot of people, especially in New Jersey, New York, and some of the other high tax states have been waiting for, is the change to the state and local tax or SALT deduction. Under the Tax Cuts and Jobs Act, that's the picture from 2017, the SALT limitation was capped at $10,000. So it didn't matter if you had income from taxes paid to your home state, property taxes, municipal taxes, whatever it might have been, any state and local taxes, your deduction was capped at $10,000. Okay. Under OBA, that deduction has been increased to $40,000 for 2025. There'll be higher limits that will be adjusted in future years. This is for years 2025 through 2028. Okay. There are phase outs. The deduction is reduced by 30% of the excess of the taxpayer's modified adjusted gross income over $500,000 beginning in 2025. Again, higher thresholds will come in later years. Another change in terms of itemized deductions, charitable contributions. Prior to OBA, under the TICSA Act, there were no floors. It didn't matter what your income level was. It didn't matter how much you contributed. There was no floor on the amount of, on what would entitle you to take a charitable deduction for contributions to qualified charities. Now, beginning in 2026, there will be a floor. Taxpayer can claim a deduction only to the extent that it exceeds 0.5% over the individual's contribution base, which is generally their modified adjusted gross income. Okay, so now, that's, I don't know for many how that's going to change things, but it does affect. So for individuals who itemize but don't give large charitable contributions, those contributions may not be meaningful in the end. Qualified car loan interest on cars that are manufactured in the United States. Under OBA, taxpayers will be allowed a deduction of up to $10,000 for interest paid on loans originated after 2024. And these are for passenger vehicles that are purchased. So it doesn't apply to the tax portion of any leases. Another big change is with respect to miscellaneous itemized deductions. Under TICSA, the suspension of miscellaneous itemized deductions under Section 67 began. OBA made it permanent. So no longer are there miscellaneous itemized deductions available. Let's talk about how OBA has affected senior discounts and standard deductions. So for 2025, the standard deduction is increased from to $31,500 for married couples filing jointly and $15,750 for singles. Seniors who are age 65 and older are entitled to an additional standard deduction of $6,000. For married couples for qualified married couples, you're talking $12,000 of additional standard deduction. So for your older clients, your senior clients, this could be very meaningful, especially if they do not itemize their deductions. This will be reported on a Form 1040 SR, which provides a chart for calculating the deduction. Social Security, not too much there. There's really no documentation, anything right now that indicates any direct changes to the taxation of Social Security. However, certain new deductions, which Marty talked about, regarding qualified tips and overtime compensation, do require a valid Social Security number, as do the beneficiaries for the Trump accounts. In terms of overall limits on itemized deductions, these are the PEAS limits. There's a permanent repeal. So the PEAS limit, which was scheduled to return back in 2026 when TICSA was scheduled to sunset. Under OBA, this was permanently repealed beginning in 2026. There are, however, other new limitations on itemized deductions that will replace the repeal of the PEAS limitations. So for years beginning after 2025, itemized deductions will be reduced by 2/37 of an amount equal to the lesser of the amount of the itemized deductions or the amount of taxable income exceeding the threshold that's established for the 37% tax bracket. It essentially reduces the tax benefit by about 2%. So in reality, this is probably going to have a bigger effect on on those who deduct using itemized deductions over the PEAS limitations. For non-itemizers, charitable deductions have also increased. They've increased from $300 for single filers or $600 for joint filers to $1,000 for single filers and $2,000 for joint filers. So there are additional deductions that non-itemizers can take with respect to charitable contributions.
Jason, what happens to the SALT deduction after 20?
After 28, it goes back to $10,000. We reduce back down to the pre-OBA limitation.
And for high earning seniors, is there not a phase out of the enhanced standard deduction?
Well, those are for non-itemizers, so, you know, they'll get that additional $6,000 each.
If I buy a foreign brand car,
The rules say that it's manufactured in the US. I don't know if it's exactly clear. I think it's geared more towards US manufactured vehicles. Thank you.
thank you, Jason, great, thanks so much. So it looks like we're getting some opportunities as filers to improve our net income and tax payments. Next, we're going to talk about the education expense deduction.
It's me again. So in terms of education expenses, there's no new federal deduction for tuitions and fees. The federal deduction for qualified tuition and related expenses on section 222, that expired back in 2020. It was not reinstated by OBA, and so for 2025 and beyond, there's no federal above-the-line deduction for tuition fees for individuals. For educators, however, education expenses still may be deductible as business expenses under section 162 if they meet the requirements that the education maintains or improves skills required in the taxpayer's employment or is required by the employer or by law. OBA does not alter these provisions. So for teachers who come out of pocket to supplement what their districts don't already pay for, they may be entitled to still take their deductions. The American Opportunity Tax Credit and Lifetime Learning Credit remain available for qualified education expenses, subject to existing eligibility and income limits. OBA hasn't changed that. And as far as student loan interest deduction, the deduction of interest paid on qualifying student loans remains in effect with no changes made by OBA.
Thank you, appreciate that, Jason. I think we're moving over to Phil. And thank you for your patience and for joining.
And I just wanted to say, I did wear a tie, so
Looks
I
very
had to
nice.
fish it out of my closet, but I found this tie. All right, I get to talk about the changes in 529. I think everybody here knows the basic rules in 529. A couple of things that have changed. Can't hear me? Okay, can you hear me now? Okay. Sound like one of those commercials. So what's changed is back when the TCJA came out, which is the prior Trump bill, they expanded the availability of the distributions from the 529 plan to post-secondary. So from K to 12, you can now take and distribute out for qualified expenses $10,000. Starting in 1/1/2026, that same availability has now been increased to $20,000. So you can now pay for somebody's private high school up to $20,000 per distributed per beneficiary. The thing that I thought was interesting about the changes in the 529 plans, that they've expanded it to include non-college expenses. So if someone goes into a trade or someone goes and does some other non-traditional post-secondary education, they now, if they have qualified expenses, can now take the money out of a 529 plan, not subject to any penalties. So if you have a child, which we all know clients who do, who decided not to go to college, but became an electrician, which they probably make more money than if they did go to college, they now, the cost of that trade is qualified expenses. So you can now take those expenses and use it. So if you had somebody who had a 529 plan and they now have a scale plan because they can't use the funds, they don't have beneficiaries who can use the funds. If you have somebody who's going to be going to a post-secondary, non-post-secondary type of trade, become a nurse, become something else other than a college or post-secondary or beyond educated person, you can now take those expenses and use your 529 monies for those expenses. And I think you were talking about the qualified education expenses, like the continuing professional ed expenses. I think the way I read the rules, you could probably take the 529 money out to pay those expenses as well and get a qualified distribution, and then also maybe get a business deduction, because if you meet all the 162 rules, so you get a double bang on those types of things. The other thing that, and I don't know how this is going to work, is homeschooled students. The expenses related to homeschooled students now qualifies for 529 distributions and expenses. How you figure out what those qualified expenses are, I don't know what tuition is or fees related to it, but I'm sure there's someone in the South that's figured out how to take a deduction for those types of expenses. So 529 is expanded to things where non-traditional beneficiaries can now use those expenses. The other thing I was going to talk about, and which is a 2-second thing, is for qualified mortgage interest. The TCJA made a limitation on the interest deduction up to $1 million of acquisition indebtedness. The new bill now, and then the TCJA made a limitation to $750,000. The new bill now makes that harmless. The second thing that the new bill did was, where you used to not be able to take PMI as a deduction, you can now deduct for PMI expenses, points, mortgage insurance. You can now take a deduction. So you have somebody who needed to pay down and had points, and if you had somebody who needed to take out mortgage insurance because they needed, the banks wouldn't give them the loan without it, then those expenses now qualify for a deduction.
Thank you, Phil. Shawn is going to talk a little bit about, for 5 minutes, a New Jersey state tax change roundup, where they're going to take a 10-minute break. Let's have Shawn for a couple of minutes. After the break, so everybody please stay around, because the raffle's at the end. We're going to talk about the New Jersey mansion tax, angel tax credit opportunities, exciting changes in section 1202, qualified small business stock. And then Jason's going to wrap up with a discussion of your income tax planning versus estate tax planning when you're thinking of transferring assets. So Shawn, quick summary of New Jersey. Thank you.
Use the podium. All right, real quick. So the first item in regards to this is the institution of what they're calling the NJ Stay program, which is basically another attempt by New Jersey to keep people in the state once they hit retirement age and there's no reason to be here anymore. And what that looks like is something that will be in conjunction with the existing Anchor program and the Senior Freeze program. They can get up to, it's basically a rebate of up to 50% of your existing tax bill. It's capped at $6,500, which means if your tax bill is in excess of $13,000, you won't get any more above and beyond that. Got to be 65, okay, and income below $500,000. You got to live in the house 12 months. This goes back, as all these programs do, to prior years. This starts back in 2024. You got to live in the house for 12 months of 2024, right? And then in the succeeding years, the entire year. All right. Unfortunately, we passed the filing deadline, which was October 31st. All right. So anybody, you're looking at next year for these things. Okay. The payments for anybody who did make application will become on a quarterly basis in 2026. And as I mentioned, it's a reimbursement, so you actually get a check back. It's not a deduction. All right. Like I said, the Anchor benefits and the Senior Freeze will remain in place, but they get calculated first before the NJ Stay program payments are made. So you can get all three benefits, but the NJ Stay portion of it is maxed out at 50% of the taxpayer's $6,500. So if you get rebates or credits under Anchor or the senior freeze that, for example, reach the $6,500 number, you do not get any additional NJ stay. Okay. However, if you are qualified, our favorite word today, and you are under, let's say you got $5,500 in credits, you can still be eligible for another $1,000 on the NJ State program. The application is paper or online, but it's all in one application. So senior freeze, Anchor, NJ State, all in the same application and process so you can do all those calculations that I just mentioned. Next, all right, and so we have to have some tax increases someplace, and one of those is going to be on what I'm calling sin taxes, just for the fact that that's what everybody calls them anyway. And it's really just increases in taxes and things that are popular to tax because they seem to be unpopular as a lifestyle choice, for lack of a better term. So the cigarette tax increase, increase in liquid nicotine products, vape, canisters, things of that nature. All right, and an increase in sports betting taxes for those people who engage in sports betting, especially online. They're going to match up those taxes with the gambling taxes. So the sports betting and the gambling will come equal. I think we can figure out where the pressure for that came from. I would also like, as a shameless plug, there are, for the sin tax aspect of it, we actually have, and it's out there, we have an inaugural issue of what we call Mandel Buzz, all right? And so we have a very robust practice within the firm that covers marijuana and licensing and those kinds of things. And there's a pamphlet out there for people who have clients who are engaged in that business. And I also have an article in there regarding 280E for those people who know what that is and how to minimize tax effects, because you're technically operating a business that is illegal from the federal perspective. And finally, because we're going to talk about this later, New Jersey has climbed on board the bandwagon for the qualified small business stock, all right, exemption. I'm not going to say a whole lot about it because I believe Marty's going to talk about it here in a little bit, but I will give you the quote from the statute itself as passed. Notwithstanding any law or regulation to the contrary, gross income shall not include net gains or income derived from sale, exchange, or other disposition of qualified small business stock to the extent such gains or income are exempt from federal taxation pursuant to section 1202. That's all it says, okay? So if you qualify under 1202, from the federal perspective, you will for the state of New Jersey as well. And I think that that's it.
Thank you, Shawn.